Welcome to our next market update. It's been only a week, but markets are still challenging, so we thought it makes sense to provide you with our next update, our current view, and also our take on the recent central bank moves by the Fed last week, by the Swiss National Bank. And as usual, please feel free also to ask questions during the next 30 minutes. You can do that by entering your question in the Q&A window or in the chat window. Now let's do a quick recap on the markets. So market snapshot, if you look at stock markets year to date, you're familiar with that chart. I showed it also last week. We've seen a tiny relief Wednesday evening after we had our last market update and after the Fed announcement of hiking interest rates by another 75 basis points, but it was very brief. Already Thursday was a difficult day. Friday was also challenging. It looks a bit better the last 2 days, but already today, if you look at European markets, it's negative again. So it remains a challenge. Sellers are really in the limelight, and risk aversion is still low, and this is reflected in a really lackluster or even negative development of equity markets. So this is what we've seen over the last couple of days. We've seen a bit of bottoming, short-term bottoming in cryptos. If you look at Bitcoin here on the right-hand side, the blue dot indicates the value as of yesterday. If you look at this morning, we are already at 20,000 again. So it is really also here risk off, exemplified by some specialities with regard to crypto. We had some negative news stemming from some of the platforms, but it's clearly risk off, quite a different situation and compared to last 2 years or like 2020 and 21. And it also this reflects the difficult market environment right now. Now, as I said, the Fed acted last week. We discussed it a week ago on Wednesday. We anticipated that at least 50 basis points are in the books, and 75 looked really likely. They delivered 75 basis points. Then on Thursday, we saw the Swiss National Bank hiking by 50 basis points. So it was really a busy week, or busy last 2 weeks. We've also seen, as a reminder, the ECB, the 9th of June, signaling a 25 basis points hike in July and another 50 in September. So also finally starting to move, also to stop the bond purchases by the end of June. We've seen the Bank of England adding another 25 basis point interest rate hike. So they started already in December last year, then in February, in March, in May, and in June again. So a lot's going on. So this happened so far. One thing is for sure, this story is to be continued. We see more hikes going forward, maybe with one exception. It's the Bank of Japan. They try to stay as expansionary as possible, and you see that now in a really weak Japanese yen. So it's basically the dove among the frogs in the central bank terminology. Though that is the kind of the one exception. And if you like if you don't look at you don't have to look just at the main central banks. If you look basically across the world, the name of the game at the moment is fighting inflation, interest rates hikes. That's the name of the game. Now they try to fight inflation. Now they're clearly not early to the game. They're late to the game. Inflation is already running high. We talked about it last week. We showed you the numbers, more than 8%, more than 9% in the US or in the UK. Switzerland is a bit of an exception still, with below 3% inflation. But what I just want to highlight here on the right-hand side is just basically it's a showcase how good we are able, and with we, I mean all professional forecasters, to forecast inflation. And, like you would assume that the most like smart people, a lot of economists with, like PhDs, are working for the S&P doing the inflation forecast because it's just the most important tool they have in order to determine their monetary policy stance, right? So what you see here on the right-hand side is the track record for the last 15 years. You see the light blue lines is each and every inflation forecast that has been published on a quarterly basis. It's always running for 3 years. And then you see the dark blue line, which is the actual inflation as it turned out. So what we observed in official numbers. And I would say it's hit and miss, and it's more miss than hit, right? Typically, the inflation turned out differently than it was forecasted by the S&P. And so the question here is, why should it be this time around be different, right? So can we be sure, if we now see an inflation forecast by the Federal Reserve, by the ECB, or by the Swiss National Bank, can we be sure that that's it now? Like inflation is turning out as predicted? Maybe not, right? Maybe there's a chance it turns out as predicted, but this is rather a small chance if we look at the track record. So this is really one message here. Don't go get too relaxed if a central bank now calls, or if some professional forecasters tells you, well, we've seen it now, right? So it's going to remain challenging. It doesn't mean we can't tell anything and we can't take any conclusions out of that. But it's just, I wanted to highlight that fact, because what we can do now is really to track closely and monitor closely inflation expectations, because in the end, it's probably the direction, at least from central banks and from financial markets, won't have so much to do with actual inflation, but much more how inflation turns out relative to inflation expectations and how inflation expectations develop from here. And this was also what Fed Chairman Jerome Powell stressed last week. So now they want to have some confirmation that that inflation dynamics are moderating, that they are abating, so that we've seen that peak inflation, and they really follow closely the inflation expectation numbers. And so they don't follow just one inflation expectation statistic. There are many out there, and I just show you two of them here. On the left-hand side, you see consumers based on the University of Michigan survey. It's been around for more than 40 years. So it's a really good data sample. And you see inflation expectations are adaptive for sure. So they moved up with inflation going up. They're standing now at 5.6% for the next year. But the worrying thing is it's still, the trend is still to the upside. And so this dynamic is not broken yet, or it's not abating. And this worries the Fed. And it's the highest reading since the 80s. And this is even more difficult if you look at, there's also a question on the 5-year inflation expectations by consumers. This expectation went up from 3 to 3.3% last time in the last survey. And now 3.3% is already quite a bit higher than the target of the Fed of 2%. So something happened here, and it's still happening, and expectations are adaptive. So there's a risk that this continues to move up, and this explains why central banks are now acting so much and doing so much to fight inflation and inflation expectations. If we look at the markets expectation, that's priced in forwards, and this is some strange construct, I must say. I don't know who came up with it. I mean, central banks look at it. Mario Draghi, it became famous when Mario Draghi referred to that. It's a 5-year forwards. So meaning forwards for in 5 years for the average inflation over 5 years. So basically average 5-year inflation in 5 years. Right. So, well, it's a lot of averaging and in the future. It's probably inflation is never turning out like that way. But what's important also here is development. I put it on purpose on the same scale. So it's of course much lower than the inflation expectations for the next year. But it moved also to the, it trended up, and it's above the 2% mark. And so this is not really like a warning signal for the Fed right now, but it could turn out to become a warning signal. So this is also something to follow closely. But it could, of course, also turn out, and this is the question now, what do we need in order that inflation comes down, inflation expectations are moderating? Well, the simplest answer to that and solution would be, like we get a recession, right? Because then this will dampen demand and so on and so forth, and then expectations would also factor that in. Well, this is exactly what's happening right now. This is the main narrative, the main discussion in markets. So no longer kind of will we see a soft landing? It's more or less kind of how hard will the recession be? And this is also supported by recent sentiment data from consumers. On the left-hand side, you see the consumer sentiment on a standard deviation scale for the Eurozone and the US, and I also show you here the US recession bands. Well, we are now really low. Like only half a year ago, we were really at still elevated positive consumer sentiment. This completely changed due to inflation and due to the negative signals in the economy mounting. And if you look at the US, for instance, it's the lowest reading also since the 80s. And whenever consumer sentiment was that low, basically, we've seen a recession. So not the best signal. It looks still a bit better if you look at the business climate indicators. They also have moderated from their peak in the US and the Eurozone. But also the dynamic doesn't look good, the trend doesn't look good. And the more and the longer consumers are negative in terms of inflation expectations, in terms of the economic outlook, the more likely the likelier it gets that they reduce spending, that they reduce discretionary spending, and this will have negative implications, of course, on the business climate, on business activity. So this is the challenge, and this is most likely not going to go away anytime soon because, like central banks have to fight inflation. So this is the dilemma central banks are facing, and this is the dilemma financial markets are currently facing, and this is reflected in the challenging market developments. And therefore, we decided in an ad hoc meeting on Friday not only to confirm our already cautious portfolio stance, but rather even to become even more cautious. So we reduced our underweight in equities further by lowering the emerging markets exposure. So now we are in emerging markets neutral positioned. We had a small overweight there. This has been reduced now to neutral. We reiterate our negative take on the US and European market. Japan is doing well, also because the Bank of Japan is still expansionary. The yen is weakening, and this supports in relative terms Japanese stocks. We'll see how long this can continue. For the moment, we are convinced that Japan is in a Japanese stocks are likely to do better than its peers, but of course we hedge the yen, otherwise it wouldn't make too much sense. And we also continue to be underweight in government bonds. There is still a risk to the upside in terms of yields, and this would be negative then for the bonds. And we reiterated at the same time our overweight in insurance-linked securities, and with that also the overweight in alternative assets. They do what they have to do, what they're supposed to do. They are not really linked to interest rates. They're not really linked to the business cycle. They are not really kind of wonder in terms of performance, but they're doing clearly better than government bonds. They're doing clearly better than equities, and with that they're doing what they're supposed to do. They stabilize the portfolio performance. But in general, we feel that in the portfolio, you feel that in the portfolio. If we have headwinds on bonds. If we have headwinds on equities, this is negative. It's almost, these headwinds are perfect storm, but in a negative sense for a portfolio. Therefore, really being cautious is the right thing to do in our view at the moment. And we are happy to discuss more specifics with you, what you can do beyond like that allocation on an asset class level in your portfolio. My colleagues are happy to discuss that on specifically with you, but you might also have some questions to me right now. So please feel free to shoot and enter your questions in the chat or in the Q&A window. Just briefly check. It's usually the dollar. Sorry, I didn't talk about the dollar specifically. It's a question on the outlook on the dollar. Well, it has not really changed our view. In the short term, the dollar can be supported if risk aversion is going up. If there's this negative environment in markets, this helps typically the dollar. But looking forward, we think that the surprise potential is more with the ECB. If you look at euro dollar, and also from a purchasing power point of view, and that favors the euro. So in the medium term, we would favor the euro. So that's our view. And question on the Swiss real estate sector. What does the recent move by the S&P mean for the real estate sector? Well, the quick answer, short answer is it's negative. I mean, at some point it was obvious that it won't continue forever, the low interest rate environment. So this is, of course, if interest rates go up, and we've seen it. If you look at mortgage rates, they have seen quite a move. So for 10-year mortgage rate in Switzerland is now at 3% or even above 3%. Just a year ago, you could get it for around 1% or slightly above it. So this is quite a game changer. And of course, now this might make it a bit more difficult to really stretch your financing for a new house or apartment. So this will have a negative impact on the demand for private buyers, and it will also have a negative impact on institutional buyers, because what we now see that now, if you look at a pension fund, the 10-year government bond yields in Switzerland going back to 130, 150, it looks again, now you have an option again, and it looks more interesting in relative terms. So far, it was pretty simple to do a new real estate project. Was more attractive for a pension fund. You get a starting yield net 2%. Of course, it's not a lot on its own, but it's clearly better than 0 or -1% on government bonds, right? But now, if you have 1.5 on government bonds and you have only 2% on real estate, well, maybe you go back to government bonds, or like you do some shifts in the portfolio in the asset allocation, and this will also dampen, of course, then the demand for real estate in Switzerland. So I think that's it. Thank you very much as usual for joining in. And also, as usual, if you have any questions, please feel free to reach out to my colleagues, to myself. We are happy and we are here for you to discuss any questions you might have. Thank you very much, and enjoy the rest of the day and stay safe. Bye.